Welcome back to another episode of Down the Middle. I'm so pleased today to have my second guest from DoubleLine after Jeffrey Gundlach come and visit with us, Bill Campbell. Bill is the portfolio manager for international fixed income at DoubleLine, which runs upwards of $140 billion, huge credit shop, obviously. And if you want to put it in layman's terms, Bill handles all of their currency and global interest rate strategies, and therefore he has to have a very broad view of the world and a good understanding of the interactions between interest rates and currencies and how that plays out. I won't walk you through his entire resume. He's got everything that he should have: economics, international business, mathematics, you name it. But he's also got a bachelor's in English from Penn State. And I'm going to, first of all, Bill, welcome. It's great to have you.
Well, thank you. Thank you for having me on. This is really a treat.
Well, OK, so why English? Help me out here.
Yeah, no, so as you mentioned, I was on the economics route, and what started out as a few gen ed courses that, were interesting as far as I enjoy literature, I enjoy creative writing, kind of turned into a few more fun courses. And then I had a counselor who said, what's with all the English? And I said, well, I kind of enjoy it. And then, he said, well, if we did a few more courses here, we can get you a BA in it. And it sounded great to me. That being said, what I thought was just kind of, a side interest in undergrad turned out to be a valuable piece of the toolbox now that, I'm in the current position and the current role that I'm in. A lot of the work we do, obviously, is economics and math-based, and, we do all of, our modeling and all of our analysis, but then we need to be able to communicate it effectively. And, being able to, write. And I also, think the act of writing helps you clarify your thoughts, but being able to express yourself both on paper and verbally, in a concise and digestible format is, I think, a valuable piece of what's required, for not only this position, but for a lot of positions. So I was lucky.
And I will say you write very articulately about some very complicated subjects. So it's clearly paid off, because it's one thing to have the knowledge; it's another to be able to convey it. And your writing certainly does a splendid job of doing that. But I'm hoping my mom's not watching this episode, because she's going to be saying, Danielle only had 9 hours left to have her master's in professional accounting. So Mom, I'm sorry, I didn't take those last 3 classes. So Bill one up me in the English department. So take us back. Where were you raised? What brought you to Pennsylvania? And who were some of your influences in your studies?
Sure. I grew up in Chicago. I grew up in a northern suburb of Chicago called Lake Forest. It was, a great place to grow up. When I was looking at colleges, I was looking for that college experience, that big university, and and Penn State, offered that to me. It was a great place to go and kind of, go from a child, I would say, to, a young adult, and, go through all of those, good experiences academically and socially that you really get in a big college town. But when it came time to graduate, obviously I was on the economics track. I, had a little bit of English, and, I was trying to, and I was coming into, the 2001 job market, which was, pretty horrific. And luckily, my cousin had married a guy who, at the time, he was a Northwestern professor at Kellogg, and now he's at MIT. His name's Scott Stern. And he now he focuses on AI and the implementation of AI. But at the time, he was in quantitative finance. And he said, look, this trying to do the fundamental finance route is, is fine. It's, going to be a tough slog, but there's this new track, quantitative finance. And, you have your, you have a background in math, a background in statistics. Why don't you get, a master's degree in math or statistics or, something quantitative, because that's going, I think, to be the the new track and the new way of doing things. And luckily, I got into a program at Boston University, which was taught or run by a gentleman from Bulgaria, Andrew Liasov, who was very particular about making us really think for ourselves and fight through proofs for ourselves.
Proofs.
And I'm glad that's in my background for now, but I think it gave me the foundation of really kind of diving into like a theoretical math framework for being able to analyze problems from my own standpoint and try to come up with an independent opinion. And I think that the founder of DoubleLine, Jeffrey Gundlach, who I have the honor of working for right now, also has a math background, and he's also known for taking independent views on things. And I think he's I think there's something to having to fight your way through that type of a pure science. It's actually I got it as a master's of arts, believe it or not. It's probably closer to philosophy,
right?
But it's a mix of philosophy and science, I would say. But being able to fight your way through and come to your own independent opinion and your independent framework of how to, both analyze and come up to answers to complex problems. So, that was the path. And, in my graduate work, my computational methods professor was also the chief investment strategist at John Hancock Financial. It was a great course, obviously. I enjoyed it, and he hired me out of the program to come work as an analyst for him. And I remember, sitting next to his secretary, and I had a very small cubicle at that point as a young analyst, and I didn't really know what to expect. And he basically started giving me what I viewed as more homework assignments, but they were kind of let's call it Markowitz or Black Leaderman, Efficient Frontier, type projects where we were looking at different asset classes, different correlations, and, changing correlations and, how we wanted to allocate, from a macroeconomic standpoint, for the firm at the time, which just led me into macroeconomics, and, my career continued from there.
So it's interesting. A few episodes back, I interviewed Marlena Lee. She's with Dimensional Funds, and she studied under Eugene Fama. And she said that he had recently conveyed to her that the efficient frontier was effectively broken, and that it was no longer applicable in today's market. So I'm curious of your views, because you've interacted within these markets since 2003, 2004, and what's changed about the subject of correlations? Because I don't think correlations as a subject are given enough attention. Having been a former Federal Reserve insider, boy, can I tell you that correlations matter. When the peanut butter hits the fan, they matter a whole bunch. But what's changed about kind of your approach to investing since you first started out?
Well, since I first started out, I, have integrated. I've integrated much more of, putting fundamental views back into, what is maybe a strict, more of a strict mathematical framework. And I think that's. I will go back and watch your prior interview. I had not seen that one, but I completely agree with the takeaway that you just pointed to. First of all, basing future returns on past returns, as we all know, is very dangerous. I think when we look at the world that we're in today, the shifts in policies that are happening we haven't seen that for multiple decades. I mean, we have to go back to post World War II to maybe see some of the central bank policies that are being put in place. So it doesn't really make sense to base an investing framework on a statistical analysis that just uses the past 20 years. Also, when we look at the inflation regime, maybe you could equate it to the 70s, maybe you have to go back even farther. So I think that, the idea that, you're going to base an investment decision purely on, a very small sample set, it's not a wise decision. Now, what I would say is correlations are very important. Correlations, I do think, it explains how the world is currently working. And I think the most important thing, about correlations are when they change. And I think that, it's when we go back and we start to stress test, different scenarios, everyone likes to go back and say, well, let's see the 2008 and 2001 scenarios. Maybe we can say 2015 and 16 and 2018 were shocks as well. But, I think that you really need to evaluate, what happens when you start pushing all the correlations up. And, it's like Donald Rumsfeld said, the unknown unknowns that, are going to kill you. And, the over-reliance that we're seeing right now, I know there's a huge fascination, with what we call artificial intelligence, which is just statistics. Like, come on, realistically, like you look at these meta classifiers, and I did them all in grad school. So, you start looking at like, you're just layering on like a bunch of different statistical analyses that, are like kind of maximum likelihood estimators. And, then you take an average of what that outcome is. The problem, again, is it goes right back to what you just said. You have a limited sample size that's based on history that might be changing. So, going forward, I think people need to be very careful about just flipping a switch on a model. And no matter how smart you think your model is, no matter how many times you reparameterize your neural network, it's not going to save you, from big changes in the world that are happening that, maybe the data wasn't available as in robust a form as it is today. But we can go back and we can analyze, those prior periods, where policy did start to reflect and rhyme with today, and make our future investment decisions based on, that type of analysis, as well as, trying to risk control the portfolios.
Sure. And it's interesting you bring this up, because if anything, investing in America, especially for younger investors who are in 401k plans, it's about as cookie cutter as you could possibly get. Most of them are in target date funds, and that is based on a model that you described. So, and it's passive in nature as well. So, I think there is a deep disappreciation for the importance of correlations in how your typical investor gets started.
I could not agree more. I think, and we're a big believer here, that active management and active research is an extremely important piece of any investment process. I know the move to passive has been aggressive, and it's this passive. And really, when you look at what a lot of the statistical work is actually doing, it's chasing a momentum factor. Mm-hmm. Right? Like everything's momentum right now. So, and one day people are going to realize that they're all piled into the same trade. And, it may be very difficult to get out, when the time comes. And I know everybody is smarter than the next person, that you'll be the first out and that won't be a problem. But, having been in markets for a couple of decades, and mm-hmm. Having tried to fight through a lot of those liquidity moments, I think you're fooling yourself if you actually are going to rely on a model to tell you when you should be taking chips off the table, because basically the model that chases momentum is going to tell you to go with it at potentially the worst time.
I couldn't agree more. I've spoken with a few people who have really done some great analysis on passive investing, and it is frightening. It's a beast that feeds upon itself. The Federal Reserve has never allowed it to be stress tested effectively. So let's talk about monetary policy. Let's talk about, because you're alluding to how policy was back when the Treasury and the Federal Reserve were effectively married to each other before the 1951 Accord, and when fiscal policy was carried out through the monetary policy channel, which is, of course, in violation of the Federal Reserve Act, which is why the 1951 Accord occurred. But where do you see where policy is now? What parallels would you draw? and where is it headed?
Yeah, well, I really think that, when we look at, both monetary and fiscal policy, we're kind of hitting the end of the runway here. When we look at what's actually happened, we've had, purchases not only of government securities, now we have purchases of private securities, even, and this is not just in the U.S. Like I'm a global person. So, quantitative easing's happening, and credit and bond purchases in the credit markets are happening in Europe. They're happening in, Japan. Japan, is also buying equities. It's also happening, across emerging markets. Like this past, pandemic in March of 2020 opened the door to all of these expansive policies across the globe. And, so far, so good, I guess. Like, we were able to, support markets. But what happened in the pandemic is we had, at the same time that you had all the purchases of, government securities and private securities, we also had a huge fiscal, impulse, a huge fiscal, explosion or, push into people's pockets. And that was a big change from what happened from the global financial crisis. And I just want to highlight this because it's a key change to understanding the inflation that we're seeing not only in the U.S. but globally today. So when we look at quantitative easing and a lot of the monetary policy that happened in 2008, it was pretty much focused on it stayed in the banking system via purchasing assets from banks. But then you credit their reserve accounts at the different central banks, which is kind of funny money or wholesale digital currency, which I'll come back to in a second. But it stayed in the banking system and allowed banks to, kind of use leverage in order to engage in, their trading activities. They were supposed to make loans, but they didn't. So what really happened there is we had asset price appreciation, because all the liquidity stayed in the banking system and central banks used it more for market making activities rather than loan activities. And it did not hit the real economy. This time around, fiscal authorities said, you know what, here's the fiscal stimulus that we're just sending checks out to people because it's a pandemic. And now effectively monetary policy is underwriting this. And lo and behold, what happened this time around? Inflation is a global phenomenon. Inflation is we saw 6.8% in the United States. It's 5% in the UK. We're in a high four handle across Europe, with Germany close to 6%. And then across the globe, it's a problem. And now it's the conundrum of our day. So when we're, as we go into 2022, one of the biggest questions is this growth and inflation handoff, and what decisions do policymakers in each country have to make? And it gets especially fascinating in international markets, because unlike in the US, international markets are subject to having the discipline of a depreciating currency if they don't react to the inflation side. And we have seen a lot of central bank tightening internationally, over the past year. And we're just starting to see the Fed, and just today, the Bank of England, and even the ECB's getting, forced into the party a little bit of, trying to turn more hawkish. And ultimately, that's creating a very precarious situation as we go into the early 2022, as this tightening of financial conditions, this reduction of central bank liquidity globally is now starting to pressure growth. So I know everyone likes to focus on like the virus as the main growth driver, but there's another huge growth driver that we need to pay attention to. Yep. Which is, the tightening policy from central banks. Now, I've been running, I've been running pretty hot there. But if you'll just allow me one more,
please,
quick avenue, I think that in the next crisis, central bank digital currencies and the new digital money that we're kind of beginning to understand, and which we're going to talk about, I know, in a little bit more detail, are going to become a much bigger player in what happens in like the next big bang stimulus, whenever it's needed. I don't know when the next recession is going to come. When it does come, I really think that that's going to be, the new, that's going to be the window or the door that opens for bringing digital technologies from kind of this, like I guess they occupy a little corner right now, to becoming more of a wholesale. I think that you will see a big replumbing of the financial system just because of all of the potential avenues that it opens up for central banks to then start implementing fiscal policy in a much more directed way. And I think that temptation that would give governments via the central bank that tool will, it's being questioned today, and people are going to debate it as we're going to debate it. But when the crisis hits, I think the temptation of that tool is going to be too great to pass up.
I will not disagree with you, but let's go back for a minute. And you said that post-financial crisis, that we effectively had wholesale digital currencies. Explain that.
Yeah. So effectively, when your account is credited, so when central banks went out and they purchased treasuries, from private bank balance sheets, and then it credited your reserve account inside the at the Federal Reserve. So you had your excess reserves go up. The excess reserve money is only effectively used in the banking system. It's not used for any other type of transactional settlement, but it's also not paper. It's a digital currency. So and it's fungible between banks. It's fungible. It's immediately settlable. So in kind of the wholesale markets, the wholesale banking markets, when you actually look at what happens, you can have intraday settlements happen instantaneously. Now, that type of technology is first of all, it provides a massive platform with which the private sector can begin to leverage and buy more, be able to provide credit to each other and provide credit to the economy. But it's also a very fast platform for central banks to be able to provide liquidity into the banking system to either pick that activity up or slow it down. Now, if we say that's the banking sector, which is great, but what about the rest of the real economy? That's where we get into the new. I think this is really where blockchain comes in, and ironically, although the blockchain is allowing all this same instantaneous low latency settlement, blockchain and the private digital currency market was started in reaction to all of the quantitative easing that was happening post 2008, and it was a private it basically was an exercise by the private sector to say, we're going to create our own little financial system that actually, is going to have a lot better, settlement, instantaneous settlement capabilities. We're going to be able both to see all transactions on the blockchain, but then protect anonymity. It's going to be permissionless. Anybody can join. There's no background or credit checks, and no requirement that you have to, go to, a Fed-approved bank in order to, be able to participate in this. And then in certain, small arenas, they're trying to limit, the amount of currency or, tokens that then can settle, on this particular network. And when I say blockchain, basically think of it as a network that allows transactions to settle. And then you can have a whole host of, different things that can settle on it, from, what they call currencies, which we can, I think the currencies are much more of a security, in my opinion, but, what they're calling currencies can settle. You can also have all sorts of new assets, such as like the NFT craze. You can have you can go buy digital art, if you want to, and it will also settle on the blockchain, which is, this private network. So, that was created in reaction to, all of this, the explosion in, really what was a wholesale digital money from central banks within, the banking system. And the central banks have realized this, and now they're starting to say, okay, we need to get into this game, and either one, we need to understand it better, we need to regulate it, but maybe we also need to be involved or create a competitor system to it. And that's where the central bank digital currencies come in. And the central banks now are, on a country by country basis, trying to evaluate, do we want to, legitimize and participate in the current, DeFi network and DeFi system that is set up today? Or are we looking to create our own, which is what China is doing? And China's completely outlawed the, private sector, DeFi system, and they're setting up their own, what they call DCEP, which is digital currency electronic payment system, that then is completely monitored with no anonymity and total control by the PBOC. But it's being implemented as a, new private sector digital money that basically is settlable on their network. And it's, and it's something that they can track and control, as they see fit. So, I hope I did a good job in trying to just at least outline.
And what you're basically saying is that the public sector is exploiting the work that's been done in a post-financial crisis world on the blockchain, and they're adapting it to their own needs.
100%. Hey, how great is capitalism? Look at when you just let, computer engineers run with, other creative minds. This is, it's creating a new marketplace. This network is effectively turned into a new marketplace. And, we look at, a lot of the trading that's happening in this DeFi world, and the, DeFi stands for decentralized finance. Mm-hmm. And that's the network, that's the private network that anybody can, go and join. Now, most people are doing it through Coinbase, where, you're starting to get a lot more legitimization, of this, basically this new financial network. But what I'll say is, one, I think that it's been amazing, the rate at which it's been, people have adopted it and been willing to put money to work in this new sector. Two, it's been amazing when crashes or drawdowns have happened, both in traditional markets. We've seen it in the crypto markets. The crypto markets have not failed. They've actually, on just the logistical side, they've functioned just fine. And that is this was initially created, just with, let's call it, it's open source code, but, shoestrings and just people kind of in their, in their homes, in their apartments, putting it together, and it held. So I think that, not only central banks, but also traditional finance companies, and the traditional banking sector is taking notice. And I think that there is a lot of work being done to figure out, how do you integrate, a lot of these technologies into the traditional banking system in order to, facilitate, more financial activity and more financial transactions.
So you've just kind of walked us through decentralized finance. What is a stablecoin?
So the stablecoin, it's a token or a currency, but it's a token that settles on that on a blockchain network, which again is decentralized network, but its value is linked to another asset, and the most notable ones are linked to the dollar. Then you have some that are linked to the euro and some that are linked to gold. Now, when we look at, the use of stablecoins, it's huge. Stablecoins actually are on one side of at least 2/3 of all digital transactions or all crypto transactions that happen. Because, if you have your dollar, let's say, you put your dollars in your, crypto account, now you want to go buy something, that the first thing you're going to have to do is, you can't just use, you have to use a digital form of the dollar. And, that's what the stable coin is. So what we've effectively seen is, there's now a new market, a dollarized market, so it's a new financial market that basically runs completely cashless, paperless. It's all digital, and it continues to grow. I looked it up this morning. The stablecoin market cap as of I think it was yesterday or 2 days ago was just below 150 billion. It was like 148 billion, and that's up from 138 billion last month when I wrote the paper. That just shows you, like, this is just the growth that's happening is tremendous. And I think sitting in the United States, a lot of us just think about investing and, wow, isn't this kind of an interesting way to maybe look at new investment ideas and gain potential returns in the portfolio. But there's a whole other world out there that in international finance that focuses on international payments. And payments between companies, obviously are all global now. Mm-hmm. But then even individuals, a lot of people come to the United States to work, and then they transfer money back to their home country to support their families, and those are called remittances. And a lot of these are starting to go onto these new digital networks, because you go to Western Union, you go to MoneyGram, they're charging you outrageous fees. It can take time to actually get there. Versus, this is instantaneous, very cheap. It's very cheap to do. So, I think that the merit of, decentralized finance as an international payment system mm-hmm. makes a lot of sense to me. And it's not just me who thinks that. Other central banks are catching on that, maybe this is a very interesting idea. And so the Bank of International Settlements is actually working on a project in Asia with, the Bank of Australia, the Central Bank of Singapore, Malaysia, and South Africa in a project. I love these names. They call it Project Dunbar, I think. And but what they're trying to do is create this central bank, blockchain settled payment system. And this is, I think, such a novel idea, because as you start to think about how international trade and international finance works, what we're seeing now is like a lot more regional based trade and a lot more, focus on, who are close, who are our domestic partners, who are the people who we actually trade with most, and let's form trade agreements with them. And so these regional, like, instead of having these overarching, one-off WTO type, global trade agreements, we've seen an explosion recently in regional trade agreements that are agreements just between a handful of countries. The WTO actually has measured and shown that, we're at 350, regional trade agreements, and that's just continuing to move up. If you look at agreements that are in place, it's over 500. So ones that, are looking to be, brought into effect. So when you start to think about, all of this regional trade that's happening with a potential new technology, such as, the blockchain, yep. I think it has very interesting implications, for the long-term outlook for the U.S. dollar and its reserve currency status.
Well, so your digital dollar. So if I hear that word, digital dollar, I find myself asking, what are the implications of the dollar effectively being pegged to these stable coins? What are the implications for the Treasury Department, for the Federal Reserve?
Well, that's a good question. I think they, the way they're looking at it right now is, first of all, like, these are being used more and more, as I pointed to. So, like, the volume of transactions occurring on the system is now reaching a status that's systemically important. So they need to regulate it. And what has happened I think the most important risk that they're looking at, and I'm thinking about right now, is a financial stability risk, because I, manage portfolios of risk assets, and, financial stability risk is something that, I need to pay attention to. Of course. And if all of a sudden, just as remember when money markets broke the buck and everyone freaked out, if a stable coin broke the buck and we are actually, it's 148 billion in transactions, as far as market volume right now, that's likely to only increase. If all of a sudden everybody lost faith in it as, more and more activity picks up, you could end up in a situation that, people just, begin to try to pull all their money out of that system and then pull their money out of other, systems, and it can, start to cascade through financial assets. So that
kind of a digital run.
A digital run, but that would then feed through to the traditional asset sector. So I think that is what they want to avoid. So what they're talking about is, why should stablecoins stay one for one to the asset that they've chosen to peg to? And the reason should be because the underlying collateral is one for one to that asset. So if it's gold, you better hold a bunch of gold. If it's the dollar, you better hold a bunch of safe dollar assets. And some stablecoin providers are doing a fantastic job of that. Other stablecoin providers, there's some questions about. I'm not going to name names, but I think that the authorities that you're referring to are taking a hard look at that, because they saw what happened in prior episodes, when kind of these core foundations of the financial market, when trust was broken that they actually could retain their value, that has implications that will ripple through the financial system. So I think that from the digital dollar standpoint, the Fed has kind of disappointed in, they were supposed to come out with the position paper this summer. They were supposed to, I know. And we're still waiting on it. In fairness to them, I think that their wait and see approach isn't all that bad. I think what people are saying, well, they're losing first mover advantage, like the market's going to run away from them. Well, I think the stable coins are actually kind of a good solution to keep them out of the issue of becoming a quasi-fiscal, tool. So we had mentioned before that this new digital technology potentially gives the Fed the ability to move from the monetary space into the fiscal space as far as plumbing. And that's a huge political debate that they may not want to enter into. And if they're saying, well, look, the majority of transactions that are happening right now have US dollar stablecoin underneath it, why don't we regulate that market? Why don't we kind of watch how that happens? If there's a huge problem, we can then, step in and potentially issue our own stablecoin or, develop our own network. But I think they're trying to take this wait and see approach because they know that, once they decide, like China, if they decide to go the route of China and implement their own network, there's going to be a lot of pressure in the next crisis for, from the government, for the central bank to be doing things that, they otherwise would like to, avoid.
Of course. Before we get to the potential that you see, and the potential risk you see for the U.S. dollar, can you walk through a little bit of what happened in the plumbing of the financial system when it seized up, as the Fed was trying to extricate itself, as we were going through the process of quantitative tightening, while global central banks suffering negative interest rates were packing a bunch of money into accounts at the Federal Reserve, while currency and circulation was going through the roof at the same time, and the plumbing seized up?
Yeah, the plumbing seized up. So, yeah, you're referring to, when the balance sheet reduction happened and, the effective Fed funds, basically the Fed. So, let me take a step back. The Fed, it tries to control, it can control money supply, it can control interest rates, and it tries to control, the amount of credit in the markets. But that second tool, the control of interest rates, the way it does it is it just tries to control the front end, at least, in its setting its policy target. It tries to control, that effective Fed funds rate, which is basically linked to the money markets. Like, there's a lot of plumbing that happens in, between the money markets that, kind of attach it to where, the Fed funds rate is. Now, what was happening at the time is we had seen the Fed, like they were talking about letting paint dry by, reducing their balance sheet or selling, government bonds back to dealers, but then taking back, all those excess reserves. But what it was effectively doing is it was reducing the liquidity with which dealers could then, both purchase, because dealers they'll use liquidity as a form of leverage to both buy and warehouse, securities, financial securities. And so there was a dual action that was happening there. They were reducing that liquidity, and they were they were just pushing more securities on them. Eventually, as they were going through their hiking, as they were going through that cycle, you saw that they were unable to control, the effective Fed funds rate, or the overnight rate. They were not able to keep it within their target band. And that was all due to, just their complete lack of awareness and understanding that the liquidity that they were just pulling out as watching paint dry, was getting worse and worse as they were just continuing to push more and more, inventory into the markets. So that really caused, and the biggest problem there is, the Fed is a confidence game. Mm-hmm. The Fed has to maintain credibility. Like, why should they be able to control, interest rates, credit, liquidity? Well, they can control the money supply, but, these other elements, why should they have, all of those knock-on implications? It's because market participants believe that they can. And if all of a sudden they're losing control of one of their main policy mechanisms because of the implementation of the policy that, that they're trying to unwind, well, wow, that can actually have much deeper systemic implications for markets. Because if markets think central banks are out of control, then, you have questions about, okay, what is the fair now? Right now, with all of the intervention that's happening, pricing is being based off of kind of where people believe policy can be and can be maintained. If we start to think like, wait a minute, policy cannot be maintained at the levels that central banks are telling us, and we know that, the macroeconomics are very different from where the policy currently is set, which is where we are today, mm-hmm. That poses a massive, potential risk, to markets, and then the knock-on implications to growth. So
clearly the Fed has waited too long. I don't think anybody doubts that, and I don't think that they fully grasped what underwriting this fiscal policy was going to do in terms of unleashing. I think other countries also hold the fiscal authorities and the Federal Reserve accountable for in some parts, because the fiscal stimulus, the fiscal thrust was so massive that it bled into other countries' inflation. So where do we go if we start to lose faith in the Federal Reserve? How could this tightening cycle play out? Because we've got a very flat yield curve right now, which suggests, and it's flattening fairly fast, which suggests that the Fed does not have much runway to try and push through this tightening cycle, much less, just extricating itself from growing its balance sheet.
Right. So, I believe that we probably have one more big bang stimulus that might work, in the global central banking system, and, probably with a lot of these, new tools that we discussed. I think that, what we're currently seeing is, asset prices are, very divorced from fair market value. We've seen now the implications into the real economy through inflation, moving much higher. And, we're going to see, as this 2022 plays out, how much of, if just the small reduction that we are seeing in, the central bank policy that is starting to reduce M2s, not only in the US, but also in Europe and across the globe, how much of that, can then start to slow down this feedback, into the real economy, on the inflation side, without completely destroying, the other balance, which is growth. So if, we start to see inflation come down because growth is coming down, I think we're getting into, a fair amount of trouble. Now, the reason why I'm kind of wavering is if it were just the U.S. that was doing all this nonsense, with the money printing and basically underwriting all the fiscal stimulus, then the implications would be very obvious that the dollar would tank, and assets would eventually, like you'd have with the inflation being a U.S. phenomenon, assets would leave the U.S. But this is a global phenomenon right now, and even central banks that have no right to do or should not have the capacity to do quantitative easing and this type of fiscal underwriting. We're seeing even in emerging market countries, and they're starting to unwind. They're trying to unwind it as well. So the question is, where can assets, where does money really run to? And I think that this idea that the least dirty shirt is going to start to play out, but this is where I think all countries are starting to think very hard about look, the amount of U.S. dollars that we hold and the fact that we've always counted on the U.S. to do the right thing. Does that make sense? And if you're looking at when you start looking at other countries where they'll say, I understand the U.S. may still be, one of the cleaner shirts, but do I want all my apples in that basket? Or, do I want to look at my broad balance of payments, or do I want to look at my trading relationships? Yep. And, does it maybe make more sense as, as an international central bank, instead of holding all my currency reserves, or the majority, 60% or more in the US dollar, do I want to start holding a basket of currencies that actually reflects the trading relationships that my country engages in over the course of the year? And that may be much lower. As we know, the US is only 20% of global GDP, but it's 60% of the global exchange reserves that are held internationally. Mm-hmm. Just by comparison, let's look at Europe. Europe is about 16 to 20% of global GDP, and their percentage of global exchange reserves about 20%. So that makes a lot more sense. So although I'm not saying the dollar will completely disappear, I think that there's a potential normalization that might happen, because people are going to say to themselves, these policies, how much longer can they go? Yeah. Bill, maybe you say there's one more, potential safety net that they can throw out. But what if I'm wrong? That I think you need to finance 101. You got to diversify that basket.
On a fundamental level, we are going into a midterm election year, so there's something to be said for whether we could in such a year, in such an instance, given what the yield curve is broadcasting. So bring into this discussion, if you will, the international payment system, because balancing away from the dollar, how can that be facilitated?
Oh, yeah. So this is where, we were talking before. I think that, right now, international payments are mostly facilitated on the SWIFT system. And, that's about 85% of all international payments via SWIFT. One side of them are the U.S. dollar. And the reason for that is the majority of global trade is done in U.S. dollars. The majority of commodities are settled in U.S. dollars. So and for the longest time, the U.S. has been a global leader in providing security, a global leader in, trying to create these, very large, economic and trade partnerships. And, now what we're seeing in the past, multiple years is the U.S. is starting to, step back a little bit from that role. And I think, especially with the implementation of the post-COVID policies, when you look at the fiscal trajectory of the U.S., and there's just one more quick aside, maybe that I could actually just put in here. Since 2008, there's been an absolute explosion in global savings that has come into the U.S. and found its home in U.S. assets. So really, what that's been is the recycling of all of the purchases that the U.S. does abroad. We give dollars and we're buying T-shirts, we're buying computers, we're buying now, additional, cars, whatever it is, all of those dollars that are purchased, there's a choice to be made. You can either sell those dollars on the market and then go buy, an asset at home or an asset, in another country, or you can take those dollars and buy U.S. assets. And since 2008, there's been an absolute explosion of that money coming back. And when you look, I like to look at, we measure that. I think the cleanest, one of the best ways to measure it is through the net international investment position, which basically nets out, all of the U.S. purchases abroad and all of the foreign purchases in the U.S. And that shows kind of the balance of, what could then unwind. So in 2008, that was about $4 trillion. And it's gone up to 14 trillion. So about 10 trillion of assets on, this net basis have come in. So when you get into this new world where, people are starting to say, as central banks may be looking at saying, okay, we're looking at, a economic model that's maybe more regionally focused. We've now entered into several regional trade agreements with, our, all of local countries that, we're actively engaged with. Our central banks are now implementing new technology that moves away from SWIFT for fast international settlement for all individuals and corporations, in this little economic region that we have set. Why do we need all these U.S. dollars as, in our foreign exchange bucket? And that, natural reduction, I think, creates a multipolar world. But, I'm not saying that the dollar will disappear. But what I'm saying is the dollar from its current 60% status may go down to, let's call it 40% or 30%. That would be a big transition. And, that potential, devaluation, the potential that has for the ability of the U.S. to still underwrite all global trade and, be the consumer of the world. And then the potential that, that then puts pressure on the fiscal authorities and the central bank to, start to address a lot of, the problems that, are building up, because then people will say, well, wait a minute, the dollar isn't just, pegged and stable. Like you need to regain that status by implementing proper policy.
Boy, would we like to see that happen. So
I would.
So what might the end game look like? I mean, you've used the term king dollar. So can the dollar be dethroned?
I think yes. I think that ultimately I see a more a multipolar world. I don't know if there's going to be a new king that's crowned. And I know there's a lot of discussion about China just waiting in the wings. To potentially be that the new world reserve currency. And I have my doubts on China. The reason that, I doubt it is that, there's several reasons. One, the institutional strength just isn't there. As a foreign investor, you don't know how you're going to be treated in a domestic court. Actually, we know not well.
We're finding out quick, aren't we?
Exactly. And as far as like how workouts and, defaults and restructurings happen in China, there are big questions to that as well. But then their capital account is closed. And what I mean by that, in 2015 and 2016, China went through this massive currency devaluation that they couldn't control. And the reason for that was domestic investors were taking money out because they were saying, look, this seems like an unstable model to me. I want to, go somewhere else. So what China did is they effectively closed that capital account to the domestic savings, not allowing it out. And, to this day, it remains closed. And actually just, about a week ago, China's State Agency for Foreign Exchange increased the scrutiny with which they're looking at, international payments, which tells you, that they're, a little bit worried that, there could be some leakage there.
Well, the Fed's going to tighten. I mean, if the Fed's tightening, that places China at risk.
And China's slowing, too, because remember, they're implementing a whole new regulatory regime in China that, has been slowing, their economic growth as well. So, are you, as a foreign investor, right now, China says, oh, no, we promise we're going to keep the capital account open for you. Now, that's a big, leap of faith. I think there are ways to, participate that aren't putting your investors at direct risk of capital controls. If you do want to participate in China, but you have to do it through, proxies or offshore proxies, which, also have, their own slippage risks. But, that being said, for all those reasons, I don't know if it's just, the dollar is going to, then be replaced by the Chinese yuan. What I think more likely is what we just discussed, is that, each individual country looks at their, broad trade, what I would call the broad balance of payments, like, not only the trading relationships, but the financial relationships as well. And you say, okay, looking at the, all of these, where do the majority of our flows, our currency flows outside of our country's boundaries go? Do they go all to the U.S., or do they go to a different subset of nations?
Your closest trading partners. Your
closest trading partners. Now, you're going to have to say some of those trading partners' currencies I may not trust as much. I don't think they, have as much institutional credibility, that there's risks such as in Turkey where, you may have policymakers doing the wrong thing, such as cutting interest rates when inflation's at 21% and likely going higher. So in Turkey, what we're just seeing is over 40% devaluation this year as they continue to, make bad policy choices. So those, maybe those countries you're going to shy a little bit less, and then you'll pick up, you'll increase your euro or your, dollar or your yen, or your Aussie dollar allocations, to offset it. But what's going to happen is there's going to be a more diversified bucket, in that foreign exchange, holding by central banks, which, by the way, we're already starting to see. Mm-hmm. And all that is going to be, again, it's going to be facilitated by the new technologies that are being put in place. That's going to offset, the U.S. domination in, kind of this global trading and financing role.
Well, I mean, the implications are vast, and it's kind of a slow bleed, if you will, that you describe. The loss of hegemony, the loss of superpower status could be something that occurs kind of gradually and methodically. As you say, because these trade agreements are increasing in numbers and becoming more regionalized. So, and again,
so I think, I think you're right, but it's, the old saying of, how do you go broke? First slowly, then all at once. Yeah. And this is where I want to just bring back the idea that all this foreign savings sitting in the U.S. is a powder keg. So yes, the international plumbing is, slowly being rewired, into this multipolar world. But once the dollar starts to go down a little bit, I can see, decisions being made very quickly, by people to either say, like, when you're going to have private individuals and companies, institutional individuals taking their money out and probably bringing it back home very quickly. And then I think central banks will react, relatively quickly as well. So I hear you that, yes, it's like the iceberg that it's slowly starting to chip, but then all of a sudden, it falls into the sea.
Well, in the event of recession, if you take your logic one step further, the Treasury is going to lose its risk-free status. So Treasury auctions won't be slam dunks. They won't be guaranteed because it's the dollar. That is kind of mind-boggling if you think about it from the perspective of somebody who's a market veteran like yourself or myself, to have the Treasury not be the risk-free world global asset.
It's interesting, where I still think we're, a little early on this trade, but just in the past, a couple of weeks when we started to see, a little bit of weakness in risk assets, the normal, this is where we're going to get back to correlations, the normal correlations that we see, in currency markets, between the dollar and the euro, and normally the dollar is a safe haven currency and goes up. Right. And we've been seeing, situations where we've had this risk-off scare, and actually, the euro's gone up against the dollar on those days. Yeah. Now, granted, it's just been been one day here and one day there. So I don't want to make a mountain out of a molehill right now. But if we're looking for tea leaves, that's something to pay attention to if you believe the thesis that I just laid out.
Well, and it's plausible, and it's also something I think that the world would welcome, whether we as Americans want to acknowledge that or not, because we take our fiscal profligacy for granted.
Yeah.
Effectively.
And that's very true. And it's I don't know how long the runway is that we have left.
Well, speaking of which, let's shift gears to China, and I would happen to agree with you that I don't think that they're in a position to unseat the dollar, the yuan. But I had a really long, interesting conversation with Leland Miller of the China Beige Book, and I'm interested to hear your thoughts about what 2022 is going to bring to China. There's obviously some very big events that are going to be occurring. You've got the Olympics, and then you've got the Congress in the fall, the People's Congress.
So first of all, the lens with which I'm viewing China is all about the October-November 20th National People's Congress. 100%. This is where Xi Jinping is up for his appointment to an unprecedented third term. It effectively, is he's assumed to, get that appointment. And once he gets it, it kind of solidifies him as, a leader for as long as he wants to be.
This is his Roosevelt moment.
Absolutely. And I think, in order to understand, let me just stick with that. So if he's going to be appointed, what he doesn't want is he doesn't want rivals and he doesn't want social unrest. Those are the two threats to, 100% to that reappointment. And when we start to look at what's happened recently, I think that, you can really begin to understand the regulatory reset, if you look at it through that lens. So when we look at a lot of what's been happening in the tech sector, a lot of that has been focused on the state regaining control of the tech monopolies, but then also trying to, take all the wealth that's being funneled to just a few individuals and spread it more broadly, which is, being defined as, common prosperity. But I think, the government saw Jack Ma and others starting to, feel that, well, I've economically become very successful, and now I'm going to push back on things that, I disagree with. And, that was clearly unacceptable, but also similarly unacceptable was the fact that a lot of people were being left out on all this wealth generation. And if an opportunity to allow the state to gain more control of these very large companies, comes in, so you have SOEs taking minority stakes, in companies, they're gaining control of a lot of, the individual user data. And then they're able to implement policy where they say, look, executives, you're going to get capped, but we're going to start, paying people more broadly. That solves, a lot of problems that have happened. When you think about, the fact we are going to have a new credit stimulus in 2022, because going into, that October-November appointment, they're going to want to make sure that the economy is humming. When that does happen, they don't want that stimulus to just go into a couple people's pockets. They want everybody to feel like they're, participating in that wealth creation. So you don't have social unrest. And then the other thing is, coming out of March 2020, you had a very large stimulus out of China as well. And as we know, China's capital account is closed, money can't leave. And, their financial markets, are, beginning to develop more, but they're not as developed as in Western countries. So we see a lot of savings sitting in the property sector. 71% of urban savings sits in property investment. And what that did is you had a massive amount of leverage that had built up. And, you had a huge financial stability risk in that sector, as well as focusing on people owning high-end properties because, that seemed like a good investment rather than affordable properties for everyone else. So here again, we have a great, coming together of multiple forces for the government. So you want to engage in a credit stimulus in 2022, but the property sector is over leveraged. So you're going to have to deleverage it first so you can actually have room to re-leverage it going in. But then you're saying, hey, developers, like you guys are just building houses like so that rich people can have 4 or 5 houses for savings. Well, no, we have a social need here. So now you're seeing state control come in, and they're starting to implement more, of the policy that they want. But when the stimulus happens, it's going to, again, have a little bit more room to run and filter more broadly into common prosperity. So as you can see, like if you take this political lens and, say, all right, I'm going to say that China is a command economy. It's being run by Xi and his people. They want a smooth reappointment, and then you start working back from there. Things start to make sense. And I think post-Olympics, it's probably end of Q1, early Q2 is when we start to see credit pick back up. And then I think you're going to have an interesting, reflationary trade in emerging markets that are linked to China, because like that stimulus, rising tide lifts all ships.
Sure.
I think that is probably, from the investment side, what you want to be paying attention to. So I think that China's growth in that whole framework, how does that translate to markets? Growth continues to remain slow in the first part of 2022. And then going into the appointment, it begins to ratchet up tremendously, and that's going to pull a lot of these China proxies higher as well. So I think, you still need to be cautious short term. I think it's a lot of people are trying to buy the dip. I think it might be a little early, but the trade will be coming, I do think, in the second half.
Of course, the swing factor, of course, is Fed policy.
Well, that's very true. But if we have a tightening Fed and, other tightening global central banks, and China in the, let's call it beginning of Q1 does not, engage in an aggressive fiscal stimulus, I think the global growth side is going to be extremely challenged, because one of the other things that we didn't talk about that also is going to be hitting early 2022 is the passing of the debt ceiling. As the debt ceiling, is now passed, what's going to happen is the Treasury is going to start to rebuild its rainy day fund, at the Fed. And it's, the Treasury builds up a lot of cash to use for, when these debt ceiling issues and other issues do happen.
They've got to get it back up to $800 billion.
Exactly. So you're having, not only are we having, global central banks tightening, removing liquidity, we're going to also have the buildup of that Treasury general account or the rainy day fund, further pulling liquidity out of the system as well. So that's another form of tightening that's going to be happening in the background. And I think the idea that China, is ready to turn, like I hear a lot of strategists talking like, oh, now's the time, like here it comes. And, we saw a little tick up in some of the, some of the credit numbers in November. It was nothing, in my opinion, that, we should be, looking for a much bigger stimulus later in 2022. I think that this opening of the first quarter of 2022, there could be, a lot of big waves and choppiness due to slowing global growth and global growth concerns.
Yeah, I've been speaking about this a lot, but people don't realize that December the 15th is, for the moment at least, it's the last child tax credit that's going to be sent out in cash.
Well, that's a good point.
So that's January 15th is going to come and go without that direct deposit. And in addition to that, you've got a lot of American families who've been taking this cash who don't realize it's going to affect the income tax refund that they're not getting at the end of January or the beginning of February. And then student loan payments are going to kick in the beginning of February. So I'm right there with you on the choppiness in the first quarter, while the Fed is expediting this tapering process and the TGA is refilling itself.
Right. So the three hikes in 2022, I would take the under if you were to ask me today because of what we just discussed.
Absolutely. So is there anything I'm missing about the world you see of the future? And well, I mean, there is one question I do want to ask, though. There's one more question I want to ask. What are the implications if eventually all the central banks have their own digital currency? So what are the implications for kind of the private currencies that are out there? Oh,
you mean, so like Bitcoin, Ethereum, and all of those? So I think that, as long as they're not regulated away, I don't view them as currencies. Like I view them more as securities. And so like everybody, you're saying, well, no, there's an exchange rate associated with them. Well, there's an exchange rate associated with IBM too. Like I can price IBM in dollars, I can price IBM in euros. Yeah. So, I think that if we think of that more as a financial market and a financial exchange, and you think of, these currencies, as either as securities, but securities with utility. So, these ideas of, especially on the Ethereum network, I kind of like the idea of gas fees, where, in order to settle, a transaction, if you are, doing, a different type of token, you need to pay, a little bit of, the Ethereum, you need to pay for it with a little bit of Ethereum. So then all of a sudden, like there's like a business model and, you can start to see, a form of cash flow associated with that. Mm-hmm. So, that makes economic sense to me. And I think that, as long as these markets are not, regulated out of existence and you're just banned from being in them, I think the ecosystem is already formed, for people to begin to evaluate, utility of, all the different protocols that are going to be built on. So you're going to have, not only, protocols such as, as I said, tokenization, just, security-based protocols, but there's also going to be new lending protocols. I think there's going to be new credit activities that are going to be placed on them because remember, this is permissionless. And if you now have the ability, to say, let me secure it. If I'm a small business and I want to securitize, some of my future sales or some of my future cash flows, but I can't, I'm not credit worthy when I go to my local bank or I go to Chase or JP Morgan, I can't get a small business loan from them. Maybe there'll be, new, avenues that have only been available to very large companies issuing debt in financial markets. Maybe these new, DeFi protocols will allow small businesses to say, hey, I know my local baker. They make really good bread. And I know that they're going to continue to sell it even if there's a recession. So, yeah, I'll take a little bit of that. And plus, I know him personally. I want to support him. There's also like ideas that, airline miles. If you create, an exchange whereby people could swap airline miles and you could buy them for, a discounted value and say, hey, I want to go on a vacation with my family. And there's an exchange for that. There are all these really creative ideas that are happening, in this DeFi network that, I think have a lot of business and make a lot of economic sense. So as long as they're not regulated away, I'm excited to see, what comes out of it.
Well, it would fill a vacuum, right? Because we don't have that much of it. We don't have the same fabric of a community banking system that we used to have.
And think about what it would do for the productivity problem, too. I mean, this is really, and you're telling me that you would allow that to, if you had a small, a new small business securitization market, developed on DeFi, that any politician would try to, say that it was okay for the regulators to regulate that away. I mean, it doesn't make any sense. I think that, eventually, the speed at which, the innovation is happening in DeFi, I think it's amazing. And I think that there's going to be a lot of things that I haven't even thought of, that come up, and just make this a viable, just new marketplace.
So I keep saying I have one last question, but I'll never forget when I worked inside the Federal Reserve, my old boss, Richard Fisher, would always, he had great respect at the time for Poland and for Mexico and for Australia. There was kind of discipline in central banking. Your world is that of currencies and interest rates. Are there any central banks out there that are doing it right?
Oh, across the emerging markets. I mean, you're seeing, Poland's have been a little bit slow. They're starting to hike now. Hungary's hiking. Mexico's hiking. They just hiked today. Across, across the emerging market complex, sans Turkey. You're seeing, central banks act in a much more orthodox manner than we are across most of the G10 complex, which is, by the way, extremely disappointing. And, it's interesting when you go and meet with a lot of, the officials, and not just the, the central bank governors, but a lot of the staff, people at, at a lot of the central banks that you mentioned and others, they're especially in emerging markets. They came to the U.S. They trained at the University of Chicago. They understand economics on a very deep level, and they're trying to do the right thing. And I think that maybe one last aside, like if you use extraordinary policy in order to arrest a crisis, and then you pull it back, and then you move with the market and start tightening as appropriate, maybe there's a place for it.
That's sound policy.
It's sound policy. It's when you just say, oh, well, now that worked, we're going to keep doing this, and maybe we'll get more benefit from it. The law of diminishing returns just puts you back into that corner, which, by the way, is a developed market problem. Yes, the emerging markets have engaged in a lot of extraordinary policy, but a lot of them have pulled it back already. And as we go forward, maybe people start to say, some of these, do we really deserve to? Do some of these emerging markets really deserve to be in that bucket, or maybe do they deserve a little bit more capital?
Yeah, no. I mean, I wanted to end on a high note, and you certainly did. Look, I've learned so much. I know the viewers are going to be so thankful for all of your insights. And let's come back. Let's come back and visit after the People's Congress and after the midterms, and see where we are. I'd love to have you back on, Bill.
I'd love to be back, and thank you for this. I had a lot of fun, and I'd love to do it again.
Thanks so much. Take care.
All right, thank you.